We're joined now by Alok Agarwal, who is the head for Quant and Fund Manager at Alchemy Capital. A very good afternoon to you, Alok. Thank you so much for joining us on ET Now. And what are you making of the market construct, given the fact that we've seen a sharp downtick in the market? Now, no doubt, we're seeing a recovery, but we did see a sharper sell-off come in markets. Do you think now India is poised to be a value buy, given the fact that we've seen that correction that was warranted?
Yeah, hi, good afternoon. Yes, we saw quite a bit of correction in the last 2 months, while the headline indices fell around 10-11% from the peak. Broader market sell-off at an individual stock level was quite severe. More than half of Nifty 500 stocks fell more than 25% from the peak. We had all the reasons as well. We saw FI selling at around $15 billion in the last 2 months on the back of slowing corporate earnings growth, slight signs of even the economy slowing down with the GST collection slow, the bank credit at a slower rates. So there were reasons. There was higher valuation, there was selling, and we saw a correction. But now the risk reward stands quite favorable. It's quite interesting to note. In fact, you also mentioned that is India a value buy. Definitely, India is much more expensive than the world. But currently, India's premium to the world stands at around 13% on a 1 year forward P basis. And this is the lowest number we have seen in the last 4 years. So on a relative basis, our premium is lower, and that is quite justified. We need to get a higher premium because of double-digit nominal GDP growth, double-digit corporate earnings growth, and the double-digit ROEs likely to continue for a longer period of time. And hence, the risk reward definitely has improved significantly.
Right. The risk reward has definitely improved, as you're mentioning, but given the fact that we have seen a sharp fall, a lot of sectors, a lot of stocks have become quite attractive, must have become at least quite attractive. So which are those pockets or which are those sectors which you find are a right value buy at this juncture?
In India, the structural theme has been consumer discretionary. So we all have been knowing that the demographics have been in India's favor, be it the younger population or the rising per capita income. And we are seeing pockets of such things, successes and growth in consumer discretionary segment. So that segment is a very, very wide segment, right from the autos to the retail to various food items. Everything comes under that. But that's the segment that's on a naturally growing structural growth basis. Apart from that, the current cycle in the economy is more capex driven. And hence, the capex related plays, the industrial and cyclical related plays are the ones that are having a higher revenue and growth visibility. These stocks have had more than disproportionate correction in the last 3-4 months. So their higher visibility multiplied by the correction that we saw recently, they make it a very attractive points to rebuilding positions in them.
Right. What's your take coming in on the banking space, actually? Because this one, this entire space, everyone's been hoping and waiting for it to make a good comeback to lead the markets higher. But banks have been beaten down quite a bit. What's your take? When will they revive? And do you think it's about time that they retake that sort of a crown of being the sector leaders?
So let me put banking or lenders and classify them into two parts. Let's first look at the top private banks or the leaders out there. So if we look at the banking credit growth, right now that stands, the last number was around 12% growth, which is the lowest in about 2.5 years. We have been seeing that because of the lower deposit growth numbers, the credit growth numbers came down all the way from 18-20% to about 12%. So that's where the headline growth numbers have got a little arrested, I would say. Then comes the next important point in the income statements, which is the net interest margin. The net interest margins for most banks are being protected. But going forward, as the mobilization of deposits gets a little difficult, in order to ensure that their growth numbers continue, there could be some let up in the margins. And the key question would be around what's the credit cost. That has been fantastic in the last 2 years. But in case there is any increase in the credit cost, that could be some question marks on the profit growth as such. Plus, at the same time, we are seeing the higher profit areas of personal loans, etc. They have been growing at a lower pace, also as guided by the regulator also. But if I look at the overall lending segment, as we mentioned, the previous cycle, the last decade between the global financial crisis till about COVID, that was a period which was consumption-driven growth in the economy. And hence, all the value chain players in and around consumption did very well. A lot of the private lenders, in terms of lenders to the consumption, did extremely well. This cycle is more to do with a capex driven growth, and in case that is likely to continue, so the value chain in and around capex and the lenders of these capex are the ones that are likely to be in a better position of showing growth and improvements. And hence, that's the reason you're seeing a dichotomy in that a lot of these banks are trading at valuations that was much cheaper. Some of them have been reporting great earnings, but haven't really seen that kind of returns. They have been overowned as well, but it's about the visibility of much higher growth that will drive them. There are certain question marks right now, but top-notch quality.
Right. Sir, Trent is one of your top holdings in your PMS strategy, but you must surely be happy given the fact that there has been a stellar rally in the share prices. But aren't you worried now about the valuations being quite stretched for Trent, or are you of the view that given the expansion plans of the company and given the diversification that they're doing into lab-grown diamond and beauty products also, this premium valuations would sustain going forward?
Thanks. In fact, you partly answered that question. In the consumer discretionary space, especially the retail space, while the opportunity has been huge, there has been no debate around that. But to our surprise and to the surprise of all the market participants, there have not been too many successful players out there. What certain companies have done is that they have executed their strategy so well and executed in a manner that was really liked by the consumers and the shareholders alike, making growth come by without committing too much of capex at a much higher ROEs and the execution rates being faster. And once you achieve that success in particular line of business, say clothing, etc., and you want to replicate it in some other areas like lab-grown diamonds or some other grocery segments as well, then the whole area of growth opens up. The key point is that is there a growth in the overall segment or the huge opportunity size? The answer is yes. And do you have a very good executor out there? So as long as that is there, the higher growth visibility for a longer period of time can sustain higher valuations.
Right. Alok, I wanted your view coming in on the IT space, because you're seeing some sort of a renewed vigor when you talk about the entire IT space, especially after the US presidential elections. Everyone's betting that the fact that the spending may be better and therefore benefit our Indian IT companies as well. What's your view coming in on the IT place? And do you think that now could be the time that you can actually relook at this, because you've seen a fair bit of actually fervor coming in these counters already?
Absolutely rightly said. We saw a lot of fervor come in this sector in the last few months. If I look at the IT index in particular, it trades at around 29 times on a 1 year forward basis. And next 2 years, earnings growth on a consensus basis is being projected around 13-14%, which turns out into a PEG ratio of more than 2x, which is actually more expensive than the market. Given the election results in US, there have been expectations that there would be a tax rate cut in the US, which could lead to more IT spending by the companies out there, and hence the top line, etc., for our IT companies may improve. We have yet to see that improvement in the guidance by the companies themselves. We would await for that. Some of these companies are great quality companies, but had been lagging only because of lack of growth. But if we come down from the top companies, the larger names, towards the larger mid-cap names, some of those companies, especially in the ER&D space, etc., they are the ones that are actually having a higher visibility of growth. So that's why we divide the sector into two parts. Those which are having difficulty in growing at a faster pace, that's where we are underweight. But those which are actually growing at a much faster pace and also gaining more market share within the IT space are the ones we are positive on.
Well, thank you, sir, for joining us and sharing your perspective about the markets.